Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Sunday for Sunday, November 7th, 2021. We've got another great show for you this week. I'm going to be joined by members of the media, academia, and financial services as we analyze all the news in retirement markets, technology, personal finance, so much more. We've got another great show, so sit back, relax, enjoy this episode of BRN Sunday. We're going to kick things off with a look at what's going on in Capitol Hill, and they're joining us from a remote location today. They are better known as the Legal Eagles, but we also know them as Dave Levine, Kevin Walsh. Both are principals with Groom Law Group, an employee benefits law firm based in good old Washington, D.C. Gents, thanks so much for joining us on the program this morning.
Jeff, it is good to be here. Of course, with things in D.C. these days, we're all tired because things are moving fast and slow at the same time.
Absolutely.
So, Jeff, you can say where we're coming from. I mean, I don't think we can quite yet say that we're from bright and sunny San Francisco, but we are from San Francisco this weekend.
Well, yeah, and that's a beautiful part of the country. Hopefully you're getting out and enjoying some of the great weather and the restaurants, because they have great restaurants there.
Yeah, so I mean, one of the key things with San Francisco is, it's where the Speaker of the House is from, Speaker Pelosi, and that's where the action is this week.
Yeah, so tell us, Kevin, what's going on with this bill? Some provisions are in, provisions are out. I feel like I'm doing the hokey pokey.
Well, I think that the Democrats feel largely like they're doing the hokey pokey with provisions being in and out because.
Wait, is this Groundhog Day too?
It's
it
Groundhog
is
Day again, David.
Okay. And given the time we're recording this West Coast time, it feels like the alarm in Groundhog Day.
Well, and I think this week the jig is up, guys. We're recording this segment on Friday, and by Sunday there could be some changes. So on Thursday, the Democrats negotiated a number of changes to Build Back Better, which is the reconciliation package. And as part of those changes, they added in 4 weeks of paid leave. They're revising a number of other provisions, but they added back in 2 pay-fors that are very important to our space. First, they added in, limits on the amount of assets someone can have in their retirement accounts across the board. So if you have more than $10 million, you have to take out a percentage above that, and you're not allowed to make additional contributions. If you have north of $20 million, you've got to take out the amount above $20 million, in the following year. Now, one of the things that they did with this time as opposed to last time is they've corrected the language so it's much less likely that an individual would pay a penalty for these required distributions. So that's a significant change. Now, there's still some qualms about the idea that, the retirement system is designed to accumulate assets and that we want to encourage people to save and that these caps could come down over time if Congress has more money. The second provision, and David will talk a little bit more about it, there's some disqualified person provisions, but before we get there, I want to give just the where we are today and where we may be by Sunday when you're listening to this with respect to the reconciliation package. And where we are today is on Thursday, Speaker Pelosi said they will definitely vote on Thursday. Definitely vote on Thursday. Now, that was yesterday. It's now Friday morning. And the alerts that I've been reading this morning say that they are definitely going to vote today. So by the time you listen to this, this could have all cleared the House and just need Senate passage. Now,
wait, is it going to actually pass the House, Kevin?
Well, they've said definitely pass today, but they've also said that they could be in session this weekend if it doesn't definitely pass today. And so there's some uncertainty as to whether this is going to actually get through the House today. And then, should it get by the House, it would still need to pass the Senate, the Build Back Better piece. There's a bipartisan package, which once it clears the House, it's done, just needs to be signed by the president. But the piece that has these provisions we're talking about, they still need Senate passage. And over there's a number of obstacles. In particular, it seems as though Senators Manchin and Senator Sanders would both like to change this bill in ways that would make it tougher to keep both of them on board. So that remains to be seen. And that action will not be, this upcoming week because the Senate's out of session. So we may still be talking about Build Back Better in future weeks, And David, do you wanna just do a quick overview of the that provision that I glossed over?
Sure. There's one provision in Build Back Better that we're looking at it right now. It relates to IRAs. Some of you out there, it's a part of the retirement space. Things, for instance, with rollover as a business startup, where you basically use your IRA to fund your business. In English, the bill basically has you look through if your IRA owns more than 50% of a business, and it basically treats you, the owner of the IRA, as being the direct owner for some purposes of the underlying business. Translated, it can mean you may have a bit problems, and it may create IRA tax prohibited transaction challenges if you start doing transactions with a company, pay yourself money after you own 50% with your IRA. It's very wonky. We could spend a lot of time on it, but the provision in there could raise some questions for people who like to fund things or have large stakes in businesses through their own IRAs. We'll have to see where this goes. It's something that's just part of it. We'll see what happens next. That's the short form, Jeff.
Yep.
Why don't we see? We'll see if by next Friday when we record, we're still talking about this.
Yeah, and it's, I wouldn't put you guys on the spot to say what the probability is, because it's so undefinable. But I think just kind of you guys being able to break down what's in, what's out, and we'll know more, as David and Kevin said, we'll know more Sunday when this weekend after it airs, and maybe we'll even do a special show next week to kind of bring people up to speed. David, Kevin, thank you so much for joining us, especially if you're out on the West Coast and you're up 3 hours earlier than everyone else out there. Have a great rest of your weekend. Be safe, and we'll talk to you again very soon.
Thanks, Jeff. It's always good being on the show. Thanks, listeners.
Thanks, guys. Bye-bye. Now we're going to tackle tech and consumer products. Joining us on the line is lead advisor, executive producer for 7 Investing. We're talking about Daniel Klein. Dan, great to have you back on the program. Happy Sunday to you.
Good morning, Jeff. Happy Sunday. When this actually airs, I will be somewhere in a plane on the way to Las Vegas.
Viva Las Vegas. Well, I hope you have a good time, Daniel. Are you going for pleasure or is this business?
So it was business, but the business part got canceled. So now it's pleasure.
Okay. Well, I hope you have a great time. Dan, I want to ask you about 2 really great topics. It's kind of divergent topics here. The first one is Amazon planning to launch the first of 2 prototype satellites in late 2022. We had talked about this Project Cooper, I don't know, 6, 8, 12 months ago. So what can you tell us?
So let's forget the Amazon part of it. Let's just throw this company is going to put 3,600 satellites into the air, and that's going to give, let's call it affordable, though they haven't named prices yet, internet to places that are not well served by internet. This is very similar to what SpaceX is doing, though the SpaceX, hard to argue it's affordable. Though their program is still considered a prototype, you pay $500 for the dish, and then it's $99 a month. But what this does is it brings internet everywhere. It also brings internet competition everywhere. This is very high-speed internet. So in theory, for example, last night my internet was out. I had no internet from 10 o'clock in the morning until at some point after I went to bed last night.
How did you manage, Dan? Hold on.
I used a hotspot to work, which was basically like using dial-up.
Yeah.
And I had no hint of that it wasn't going to come back, so I always just assumed it would get fixed, and I called a few times, and they told me, like, yeah, technicians were working on it, or else I would have just gone to Starbucks or an office or something. But imagine if I don't like the company I have, which I do not, and I decided, you know what, I want an alternative, and I could go out and buy a satellite dish for $100 or $200 or whatever it is, and then for less money than I'm paying per month, get better internet service. That is, in theory, what Amazon brings. Now, do we like the idea that a giant corporation that's maybe leans a little towards evil is going to have a huge satellite network above us? We've all seen that movie, and it doesn't end well. But on an altruistic basis, bringing internet everywhere is a good thing.
Yeah, okay. So Dan, let's talk about where internet is needed here in the United States. I think excuse me, areas, they don't have access to a lot of internet. They don't have access to hospitals, both things that we've talked about on this network. And then I'm thinking about some of the emerging markets, right? Um, does this have an application to either of those
Yeah, it,
marketplaces?
it, it does. And it also gives people choice. So you look at where I live, and West Palm Beach is a very mixed city. I live in a relatively well-off housing development, and right outside our walls are some pretty not nice places to live. Well, those pretty not nice places to live probably only have one choice of internet.
Hmm.
So if you have one choice, your price is your price. There's not much you could do about it. When you start to add competition, that forces everything lower. So sure, this is good for that rural hospital or the unserved population in India or Africa or wherever it might be. But this is also good for parts of the American market that don't have a choice and are really forced because you need internet. Like your kid basically can't go to school if you don't have a good internet connection. This is something that basically is table stakes for American life, and this type of product should democratize it, should bring prices down.
All right, Dan. So I agree with you. It sounds like, anytime the consumer has choice, they're going to benefit. But you know as well as I do that big companies can afford lobbyists that can lobby Congress, they can lobby the regulators. Are there roadblocks to the not SpaceX, this Amazon Project Cooper?
I think there might be public pushback about all the different companies. There's three or four of them putting thousands of satellites into low Earth orbit. I think that there might be some pushback, but here's the reality. SpaceX is well on its way to doing this. There has to be a second piece of this, and there is an emerging industry that will do this, but cleaning up space junk is a real problem. We are going to need to deal with that. But I do think that the Comcast and the Charters of the world probably fought against this. And as much as they have a lot of money, they don't have Amazon money.
Yeah, that's true.
So this really is the right companies doing it to make it happen. This isn't some startup that Comcast can go and say, oh, it's we think they haven't tested enough. Maybe it's going to scramble your brains or whatever. These are giant companies that have tested it out, that are taking on the establishment. And it's weird to say Amazon's not the establishment, but when you're taking on like old school evil companies like Comcast, you being new school evil almost seems quaint.
All right, Dan, let's talk about another. We're going to flip from that to internet to home buying. And Zillow announced that it's going to eliminate a whole bunch of jobs and get out of the home buying, what I would call flipping business. What can you tell us there?
So, Jeff, I don't want to gloat. I don't want to take a bow, but I've
But you
probably
will.
done
But you will.
I probably did 200 shows over the past 18 months where I said, everyone's throwing iBuying as this great thing, but nobody's going to sell their house at super cut rates. I mean, there's always been, we buy ugly houses, and the market for someone who's just desperate to get out, there's always going to be a tiny percentage. But Zillow was largely buying houses at slightly under market rate. So they would go to you and say, hey, look, you'd pay your realtor 6%. You'd give us another couple percent. We'll offer you 10% below market, but you won't have to market your house. You won't have to do anything. We'll just buy it from you. The problem with that is Zillow then has to come in and spend money to clean up the house, to do whatever it thinks is needed, and that's of course a guess. And then it has to assume that the housing market doesn't dip at all. So you're not talking a lot of margin. And yeah, the housing market was crazy, but that even makes more risk. Like if you know that like consistently, the price of a 3-bedroom condo in downtown West Palm Beach hovers around 300 to 320, that's a lot easier to predict if in a year it bounces between 300 and 450 and you don't know where it might be at the time you put something up for market. So Zillow bought a lot of houses, billions of dollars worth of inventory, and it's going to take a loss on selling those. But look, I think this entire business that Zillow is in is a terrible business. So what's their core product? Their core product is, well, why are you paying your realtor 6%? So in theory, they provide realtor-like services and they charge less than that. But here's the problem. In a tough market, which most markets are on some level, a realtor's 6% or 3% to the buyer, 3% to the seller, which the seller pays both half of that. That's not a lot of money. So Zillow's going to come in and do that electronically for 3%. What did you save? My realtor, who sadly passed away a few months ago, has saved me a ton of money, has helped me get properties I wouldn't have otherwise been able to get. Zillow was solving a non-problem. Now, where could their business be? They could have a nice business matching people to mortgages and home inspections and insurance and things that you can make nice long-term commissions on. That could be a good business. But in reality, I don't think this might be a nice business. I never thought it was a good investment. And iBuying is, you called it flipping, you're right. And flipping only works for people who can do the work themselves efficiently. And even then, it doesn't always work.
So there might two questions. One, is there a sigh of relief from traditional real estate agents on this and the traditional industry? And that's number one. And number two, it just seems to me, based on your comment, that the people aspect of buying and transacting business really important, hard to replicate, especially in a overinflated market like we have right now.
I don't think good realtors, the top of the market, were worried about this at all. So I tried when we were looking in Orlando, because it's not my realtor's coverage area, the places we knew we wanted to buy, she was representing us. And then in looking around, I looked at Zillow, and Zillow connected me to an agent. And the agent was young and pretty incompetent and didn't do a good job. And the problem is, the best agents have clients they work with. They have word of mouth. It is tough to build up a practice as a real estate agent, but once you do, you have that practice. You have people who are loyal to you, who are going to swear by you. So do I think this was maybe dangerous to the next generation of realtors? Yeah, probably. It might make it harder to get started. But digital buying only works when the market is sort of good on both sides, when there's a reasonable amount of supply and a reasonable amount of demand. Well, yeah, then you don't need a smart person. But when we bought our resort condo, we were one of 11 cash offers. My realtor called the other agent multiple times a day, and it was one day, it was a one-day process, and asked the questions about what we could put in our offer that would make them more confident, because we were actually only a quasi-cash offer. We had sold our condo, but we hadn't closed yet. The fact that my realtor could say, hey, look, I've worked with these people multiple times. This is the closing date you want. They say even if they don't close, they can get the money to close this, which I could have done through family. The fact that I had a realtor, that mattered. I don't think these sites were ever threats. These just aren't the big businesses. And look, people are going to get mad. They're going to this is an opportunity for Redfin. This is an opportunity for Open Door. No, it's not. And I think there's a fundamental misunderstanding. And I get it. People get angry about 6%. If you get angry about 6%, you don't understand what a realtor does. And I think ultimately there are going to be businesses that can't be easily digitized.
Dan, can't you negotiate the rate that the commission that the real estate agent gets?
So in a mediocre market, I used the same realtor in Connecticut for 6 or 7 transactions. And on his side of things, on the sell side, he always took, after the first transaction, he took 2% instead of 3%. Mm-hmm. On the other side, there's not much he can do. Mm-hmm. So you might get it down to 5% if you've worked with someone. But in a very hot market, when we sold our condo here, I wasn't going to ask my realtor to take a lower percent. She had as many things as she could possibly sell at a much higher price than what I was selling, mm-hmm. and she put the time in to sell my condo. You have to be, aware of that. And sure, if it was a slow market, or if it was an okay market and I was picking a realtor for the first time, there might be some ability to negotiate. But I'm pretty convinced my realtor sold my property a couple of months before and at a higher price than I would have gotten had I just used someone just okay. Well, what's that worth? That's probably 30%, $30,000. And when you count what I was paying in mortgage and cost to keep it, plus selling it for extra money. Well, $30,000 is 10% or 8% of what I sold it for. So what are we talking about here? And again, there's cool digital markets. I love getting life insurance through Lemonade digitally and not having to do it the old school way. I bought my car from Carvana, a great way to do it, but there's not a lot of interpersonal negotiation when you do those things. Yeah. When you're buying and selling a house, especially when you're buying now, there might be multiple offers. Having someone who can guide you through that process and help you get it when there might be other bids that are higher than yours, that's really, really valuable. So again, I've talked about this, and look, it's easy to be the contrarian. It's easy to say this isn't going to work, and you'll be proven right a lot of the time. But this was one I was pretty sure fundamentally just wasn't a great business, because house flipping, as much as everyone thinks they're going to get rich doing it, looks great on TV. It's really dangerous if you're not a highly skilled contractor buying something that you're very, very acquainted with.
Yeah. Well, Dan, really good information. Thanks so much for joining us this morning, and have a great rest of your weekend.
Thanks, Jeff. I'll see you next week.
Welcome back, and now we're going to talk a little real estate. Joining us on the line, he is the real estate reporter, I should say, for Market Watch, Jacob Passy. JP, good to talk with you. Thanks so much for joining us this morning.
Glad to be here.
All right. Lots going on in the real estate world. We're not going to talk interest rates. We're going to kind of let that gestate for a week, and what the impact is going to be on mortgage rates. Let's finish up the conversation we started earlier in the show on Zillow. Really interested to hear your perspective around this significant development.
Yeah, so I mean, you probably covered it already, but Zillow is leaving the iBuying business. Not immediately. They're going to have to take some time to sell off the homes they had purchased. But it's a pretty shocking turn of events. This has been kind of brewing for a few weeks now, because in mid-October, I should say. I don't know why I said March. Mid-October, they said that they were taking a pause from buying more properties through Zillow Offers, which is their quote-unquote iBuyer. And for those who don't know what an iBuyer is, it's a company or division of a company that basically flips homes. They use algorithms to create a price for a home that they offer directly to home sellers, and then they buy the home, spruce it up a bit, and then turn around and sell it. So Open Door is the biggest iBuyer in the market. Zillow was number 2, and then OfferPad is another big one, and Redfin also has a small iBuying division, and there are a couple others that are experimenting with it. But, it's been hailed as this kind of trend for the future, and, the big question that came out of this was whether this was a Zillow problem or an iBuying problem. So what basically happened is, what we're learning now is that Zillow bought way more homes than normal during the most recent quarter, and they were being very aggressive. And they were, the way iBuying is successful is you offer, a price that is a discount to, you don't want to buy a home for more than it's worth from the get-go, because then you're going to have to make up that difference somehow. So, companies, they typically strive to, price their offers to home sellers at slightly below what the home is worth. And the reason why a home seller might take that offer is because, this whole process is much easier. It's essentially a cash offer, so it's much easier than going through the rigmarole of listing your home for sale, dealing with bids, dealing with mortgages, all that. So, and some of these companies, have experimented with other things where they'll you can sell your home to them and then rent it back from them for a period of time to give you some flexibility to move out, et cetera. And it's useful for homeowners. One of the big challenges a lot of homeowners face is, if they're trying to upgrade to a new home, or if you're moving across the country or something like that, you don't want all the stress of, a typical real estate transaction. So that's kind of the MO of iBuying. But it only really makes sense, as we're now seeing from Zillow, if the companies that are doing it are offering less than the home is worth. Zillow was not doing that. They were offering more than what the homes were worth. And now they found themselves in a precarious position because a lot of the homes are underwater, meaning that they are now finding it difficult they're basically now having to sell these homes for less than what they paid, which is, you're losing money then, quite obviously.
Yeah.
They also cited challenges in terms of, the costs associated with renovation, because it's still hard to get, contractors, materials, et cetera. So, that was another factor they said. So basically, initially in October, they said they were pausing, and now they're leaving. They are, selling off their remaining inventory and fully exiting the business. And the kind of general consensus that garnered from real estate experts and analysts is that this really was a Zillow problem. You don't see the other companies that do iBuying having these same issues. I mean, Redfin, they reported their earnings on Thursday, and when they were talking about they're still actually very cautious and kind of pessimistic almost about iBuying. They kind of only do it because they feel like they kind of have to be able to offer comprehensive services. But Redfin was saying, like, for their pricing, they were getting 100% or more, they were basically their target price for the homes they were selling, they were reaching or getting prices above that target. So, they are making money off of iBuying. Open Door is still expanding. OfferPad is still expanding. So it really does seem like this was a Zillow problem. Of course, now the follow-up question to that is, so how did this problem start?
Okay, well, so you're taking over both sides of the interview, Jacob. I'm happy to let you do that. I'll sit back because that was my question.
No, sorry.
That was my no. Don't apologize. That was my question to you. So if it's a Zillow problem, is it just unfamiliarity with this market? Is it unfamiliarity, or is it a bad process on their part? I mean, conceivably paying more than a property is worth, and then investing money to improve it only makes it more underwater. So what's the recipe here?
Yeah, I think it's first of all, the answer is not clear exactly. And one story I did this week, in response to all this news, was looking at the Zestimate. So, if you own a home or if you've been in the market to buy a home, you probably know what the Zestimate is. It's one of Zillow's main tools that they offer to customers on their website, where you can look up the estimated value of the home, the Zestimate. But believe it or not, that was actually those figures and that's based on an algorithm and all that. That was the starting point for the offers that they were making on homes. So there is a little bit of a question out there as to what's going on with the Zestimate, and that's not a new question. I mean, for years now, there have been complaints that those values were either inflated or deflated, that the Zestimate was either above the actual price or below the actual price, not actually meeting it. And there is a margin of error there, and Zillow is open about that. It's about 2% for homes that are on the market, and about, I think it was 7% for homes that aren't being listed currently. So, but that's that can add up to a lot, and actually that 7% figure might be noteworthy, given that a lot of times people will go to an iBuyer before they even list their home. So Zillow has a larger margin of error for the homes that aren't listed yet, and that's their kind of main customer base. That tells you a little bit of something. But there's still a lot of questions out there. I mean, they say it was just a starting point. They had started experimenting with basically making the Zestimate into a cash offer. So in some markets on very specific properties, they were willing to just give the seller the value of the Zestimate in an offer, without, doing any, adjusting to it, because I think the idea was that the Zestimate initially was a starting point, but then they would adjust to take into consideration renovation costs and things like that. Zillow says when I asked them about this, they said that their Zestimate is fine. The issue was really with the difficulty they were facing in terms of forecasting home prices, and that is a difficult thing to do. There is also a little bit of a question as to whether some of this and Zillow's decision to leave the market is related to concerns about where the housing market itself is headed. So, one real estate expert I talked to said Zillow might be something of a canary in the coal mine here. They may have seen, they're facing this difficulty already. Some of that is probably their own processes not really being right for the iBuying market, and it's hard to do this right. Mm-hmm. If you watch, Flip or Flop on HGTV, that's basically what companies like Zillow are doing on a massive scale. So, it's easy to see how you can lose a lot of money on this. And Zillow lost a lot of money on this. It's hard to underscore that enough. But there is an extent to which Zillow may have seen the writing on the wall with the direction of the housing market. Not going into interest rates too much, but they are still expected to rise, and there are concerns that will really cause a lot of people to have less interest in buying or, wait on the sidelines. Home prices are still rising, although that might be slowing down, which could become a challenging market for iBuyers, depending. And there's also concerns about affordability and whether we're going to get to a point where just the people who would like to buy a home just can't afford it.
Yeah.
So there is the chance that Zillow saw all that and said, we're already having trouble. We're already not really doing very well in this business. And to be clear, most of the iBuying companies have yet to turn a profit, really. I mean, they have seen their revenues grow, but they have so much costs associated. It's not, no one's really fully cracked the code yet, I would argue. But they may have seen the writing on the wall that we're losing money on this, and the market's only going to get more challenging. So let's get out while we still can, without too much pain. So that could also be the situation here that they already decided it was too hard as a business to deal with, and don't want to lose too much more money on a bad bet, basically.
Yeah, and it kind of reminds me of what you're describing. If you ever saw the movie Margin Call, are you familiar with that movie with Jeremy Irons and?
I know of it. I actually have never seen it.
Oh, it's a great movie, but it's actually
yeah.
the beginnings of the 2008 crisis,
Yeah.
and so they foresee this and sell all their MBS and their securitized loans. Anyway, you're right. It could be prescient, right? Because if they say, hey, things, and all economists, Jacob, are saying, not all, but I think a great majority of economists are saying that things will slow down more in 2022, and we're not going to see this buy up. So maybe they're saying, hey, look, we've got enough inventory. Let's just move it, and let's move in. Let's go stick to our core business.
Yeah. I will say, though, I talked to the CEO of OfferPad, which is one of the biggest iBuyers, and he has the opposite take, where he actually argues that a slower market might actually be better for iBuyers because, yes, you might see less demand for the homes that you are trying to sell, but the flip side of that is it will be easier for an iBuyer to get a good price on the homes they buy because, potentially those sellers will be desperate enough to, offload their homes at a significant discount. So he was arguing that, the acquisition costs will get a lot lower, which can benefit the business. Redfin makes the opposite argument. They argue, and they buy far fewer homes than the rest of the iBuyers, and they're very cautious on this market. They argued that, with interest rates rising, all these companies tend to have to borrow money to, fuel these offers. And he was like, you're borrowing, their CEO during the earnings call was like, your borrowing costs go up. That makes it more challenging. And then also, affordability issues will mean that, demand from home buyers is lower. So you don't want to be too, heavily leveraged in a market like that. And for that reason, Redfin, they said that they've slowed down the number of homes. They're still expanding their business in terms of the markets they serve, but they're being much more pragmatic with the offers they're making. So, it'll be interesting to see what happens in this market, with the companies that are still doing this now that Zillow's exiting. I wonder to what extent we might see, it'll be interesting to see whether any other of these companies start to experience some of the issues Zillow has said it experienced before it decided to abandon ship.
Yeah, last question, Jacob. Do you see people just having learned, going through this process, maybe pivoting back towards the real estate agent and a human being or part human being, as opposed to just shopping online and transacting business online? Does this swing the pendulum the other way? Because there's talking with Dan Klein, there's value that a real estate agent can bring to a relationship. So I wonder if this kind of dings that a little bit, and if people, even younger people, say, okay, I'm going to do my research on Zillow and Redfin and all this kind of stuff, but maybe I'm going to secure my loan, I'm going to do my credit validation, and I'm going to work with a traditional lender and a traditional agent. Where do you think that all kind of plays out, or is this really premature to say that?
Yeah, I think it's a little early to say. I will say, one thing I thought was interesting that, OfferPad CEO brought up was, as they've expanded to more and more markets, it's gotten easier to do because the American public more generally, is is becoming more and more familiar with this process of, buying and selling homes, these companies that are doing this. So, he said kind of like, when they first launched years ago, they had to do so much education in each market they went into to, even just tell people how it all worked and get them up to speed. And he said, nowadays they're not really having to deal with as much of that. It's, the opposite. They're, able to kind of go into a market and just kind of, people just kind of know how it works. So that speaks to the fact that, and Glenn Kelman, the CEO of Redfin, he made a comment where he said, iBuying is not going away. It's here to stay. But he argues that he doesn't see it becoming, a significant portion of the market. He expects, he was like, I think the forecast he had was like, eventually iBuying will probably come to represent, no more than 10% of the real estate market share. And that probably speaks to the fact that, at the end of the day, if you're selling your home to an iBuyer, chances are you're getting a lower price than you would get if you listed it on the open market.
Okay. Well,
that is something that has been something that we've all reported on. But there are circumstances where it makes sense for people to do that because they just want to, offload the home and get out of it, and get, if they're moving across, like I said, if they're moving across the country, or maybe you're trying to buy a home and just need to sell yours quickly so you can have the profit to use as collateral for, your next home. All those things, will factor into this being attractive to some people. But, as long as people are not, making as much as they could on the open market, chances are we're still going to see most people go to the open market, I would argue.
There you go. Well, Jacob Passy, always a pleasure chatting with you. And I walk away and I am ready to buy a home. Just kidding. No one call me. I'm not ready yet. Have a great rest of your weekend, and we'll talk to you again very soon, Jacob.
Talk soon. Take care.
Bye-bye. Welcome back. Now time to talk healthcare. Joining us on the line, she is the healthcare editor for Business Insider. She's also the editor of Dispensed, the weekly healthcare newsletter, aggregation, curation of all the important news each and every week on the Business Insider platform. Talking about Lydia Ramsey Flanzer. Lydia, thanks so much for joining us this morning.
Yeah, thanks for having me.
So, lots going on in the healthcare space, lots going on around COVID and vaccines, but what's top of mind for you and the team over at BI this week?
Yeah, we can start with COVID. One of the big things that came out this morning is that Pfizer has been developing an antiviral pill. You might have heard Merck's been working on one as well. These are pills designed for you to take them really early on in getting sick, and the idea is to keep you out of the hospital and keep you from, dying. And this is kind of just another line of defense for people who have not gotten vaccinated or for people who have compromised immune systems, especially, but really for everyone. And the Pfizer data was super interesting because they found that there was an 89% reduction in hospitalizations and deaths, which is pretty remarkable.
So is it, that's amazing. And so when would I take this? And I haven't never had COVID, but would I take it when I start showing the symptoms, or do I take it before, after?
Yeah, you take it presumably after you have been diagnosed. The idea is that, you ultimately want to keep yourself from staying out of the hospital. It's not something you'd want to take every single day. That would be quite a lot from a preventative perspective. But yeah, it's definitely, think of it similar to some of the flu treatments that are out there. There are some treatments that kind of act as I believe one of them or two of them are antivirals, but they're often used in cases when you get the flu. So it's not an unheard of idea of using antivirals.
And so is this official? Can a doctor, so if I am stricken with COVID, can a doctor now prescribe it, or is it still going through the trial process or FDA approval process, I guess?
Yeah, that's correct. It's still going through the approval process. What we had this morning was just the announcement that they have seen positive data and that the data looks good. This is coming from a later stage trial, so what will have to happen now is similar to Merck, which has its drug molnupiravir. That's going through the FDA approval process right now. I would expect Pfizer will go through that process pretty soon too. We should know more, and we should start seeing things get authorized if the data still looks good, probably in December. So still about a month out.
Okay. Well, that sounds quite positive. And again, I feel like when you and I first started talking about COVID over a year ago, you said that this is kind of a learned experience and that, you weren't going to hit it out of the park. I'm paraphrasing and not trying to put words in your mouth, but we're learning as we go about this disease, and it sounds like this is another step in that direction to at least abating some of the severity of a lot of these symptoms.
Yeah, that's right. So now we have, we're having coming down through the pipeline. We've got antivirals. We've had antibody treatments. These are the ones that you have to get infused when you're in the hospital. So it's a bit harder to use than just simply popping a pill or prescribing it and having someone pick it up from the pharmacy. And then, of course, vaccines are really highly effective. We're seeing boosters kind of go out. I believe it was last Friday that the FDA officially authorized vaccines for use in kids 5 to 11. So we're still seeing a lot of work happening on that front, but it's cool to see all the tools kind of get built out in this tool chest.
Yeah. What else outside of COVID? What else is kind of ringing the ears of the BI team when it comes to healthcare?
That's a great question.
I didn't stump you, did I?
Yeah.
No,
No, you're good.
Of course not. I mean, there's a lot of, I was just looking, I know.
So much all the time.
And it's amazing. I just have to say that it's amazing how America, how we as a nation, we are continuing to evolve when it comes to healthcare, providing healthcare solutions. Not perfect by any stretch of the imagination, but you and the team cover biotechs regularly. CVS and some of the pharmacies doing well. So, just curious what you all see as kind of the next frontier, things we should be focused on.
Sure. Yeah. Lots to focus on. I think one thing I'm keeping my eye out for as we head into the end of the year is kind of seeing where, we've been tracking a lot of the big healthcare bets that, companies like Amazon or Apple or Walmart and whomever have been up to, and we're seeing a lot of developments there. Walmart in particular this week, one of my reporters broke the news that they had hired someone from a health system out in Louisiana, and so that was a pretty big hire for their team. It's happening as Walmart looks to really build up its health clinics presence in the state of Florida. It's had clinics in a few other states up until this point, but the Florida expansion is one we're keeping pretty close eyes on. So it's interesting. It's definitely been a moment to reflect on, okay, what's coming down? How are people shaping up their big health bets? So that's something in particular I've been keeping my eye on.
And we're kind of, I mean, they could be, these Walmart, Amazon, others, they could be the model for healthcare in the future, right? I mean, that's what we're saying. It's like kind of like an approach where it's both in person, but also telehealth and prescribing medication, but it really has the opportunity of kind of shaking up the way healthcare up until the pandemic had been delivered.
Mm-hmm. Yeah, it's interesting. We're seeing a lot of competition for sure. We were out, my healthcare team was out at a conference in October, and it's interesting to watch some of the incumbents kind of figure out how they want to measure up or stay relevant too. So
yeah,
no shortage of interesting things happening.
Yeah, I mean, it's like you've got these two groups, maybe there's more than that, but two groups. You've got kind of the up-and-comers, what I would describe as, the startups or the companies that are outside the arena of healthcare traditionally, but are coming in. They've changed other markets and coming in and saying, how can we do it better? And then you've got the old, standard companies, right, that have always been in healthcare, will always be in healthcare, the insurance companies, and the two maybe don't meet eye to eye. I mean, I think they meet eye to eye in that they're trying to deliver better care, but there's this natural friction that exists because someone from outside coming in to make changes.
Yeah, absolutely. Yeah, it's definitely interesting, and especially seeing all the change that other folks are going through around other industries, especially with macro things like supply chain crises. So definitely no shortage of fun stories for our team to work on.
Pun intended with the supply chain. Lydia Ramsey, always a pleasure chatting with you. Thanks. I can't get it out, Lydia. Thanks for stopping by, and we appreciate you kind of doing a quick, a deep dive on a quick dive, I should say, on healthcare. Have a great rest of your weekend, and we'll talk to you again very soon.
Thanks so much. Talk to you later.
Bye. That wraps up this episode of BRN Sunday. Have a topic of interest, someone who you think we should talk to, drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, check out today's edition of our daily newsletter, The Morning Pulse. We're back again tomorrow, this time for BRN AM. We'll have a very special guest. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.